right. All right. Good morning, everyone. Good morning. How's everybody doing? See, this thing's being funny. Let's not do that. There we go. How's that? We'll start right there. How's things going for everybody? Um, our little BMY, poor man's covered call, isn't doing the greatest. That's kind of what I'm looking at right there. That's the poor man's covered call. It's not as bad as it looks, though, because we do have this little spreadsheet over here. And if you remember, the poor man's covered call is not a single trade. So you have to add up all the little positions that you've been collecting money on over a period of time. And you get to add those up and subtract them from the losses. So we got that happening for us right there. And I got this little covered call strategy going. I haven't given you this spreadsheet yet. Again, all my little spreadsheets come with your subscription to Pit News Magazine. So you'll get this with your Pit News Magazine as soon as I'm ready to give it away. But we need to work with it a little bit more and make sure we got everything in there we like. So there's what's going on with that. That's just a quick start for today. But today I want to see if there's not some opportunities to trade. But before we go do that, I'll do a little day trading. I thought that would be fun to do today. After we look at our Bristol Myers Squibb poor man's covered call, which it's a long call and the market's not been doing too well. So how's that? All right, so let's come down here and just real quick review what we talked about yesterday with the SPY, the S&P 500. And we just have a nice little ABC 1, 2, 3 top formation in here. And the market's just been it dropped a little faster than we anticipated, right? Remember, that kind of made everybody a little scared, but it wasn't anything out of the ordinary. I mean, just a little bit faster than usual. But we came right down, and we did come a little bit past the 130.9. That was kind of the golden ratio. And so we broke past that just by a touch, right? Didn't quite come down to 161.8, which, that's another nice number for us, but just broke that 130.9 just to prove that it could. And then we had that one day that the Mr. Donald Trump, President of the United States, told everybody to buy. And of course, as we talked about yesterday, that one bar right there was all retail traders. All right. There was no big institutions that said, hey, we're going to jump on board with Donald Trump on this. They didn't do that. And so, you know what? Markets don't go back up unless BlackRock says they can. And so that's what happened. BlackRock didn't approve that rise in price, so it didn't go up. So what's happening here? Well, nothing. That's just the thing. That's the game, right? We're still coming down here in this nice little second drive pattern. So this is the X1S A1. Okay. And interestingly enough, although that was a big move yesterday or a couple of days ago, that big flippy floppy thing that went on when Trump announced that they were going to pause the tariffs, that was all retail trading. No big boys jumped on board for that. They're all like, that's not what we said we could, that the market can do. Right. And so since BlackRock, Vanguard, State Street, they didn't approve of that rise in price, it didn't take off and go to the moon. So you gotta realize who's in charge here, and they're letting everybody know. Everybody who knows understands this. They're sending a message. All right? We're in charge. We will do this when we want to. We are in charge, Mr. President. Don't think you can move these markets on your own. You can't. And we're going to do what we want to do. And this is our carnival. Don't you come and mess around in our carnival. All right. So it's our carnival game. So this thing is coming down here, and this is coming into an X2SA1, right? X2SA1. And as we always say, it's about a 55% chance that this could be the bottom. So traditionally speaking, if you go study Elliott wave patterns, which is a combination part of the accumulation distribution model, the Wyckoff accumulation distribution model, the Elliott wave is part of that structure. All right. And on the way down, when you have an Elliott wave, you have three drives up: drive 1, drive 2, drive 3. And you can have three drives down: drive 1, drive 2, drive 3. Depends on whether you're in a bull market or bear market. Now, we don't know whether BlackRock wants this to be a bear market or a bull market. We don't know. And right now they could be saying, no, we're going to drive this thing down. We're going to turn this thing into a bear market. And if that's the case, then we might get three drives down, and then we would get two drives up, AB up, and then it'd go three more drives down. So you get That's the pattern. That's the pattern. So right now we're at an X2SA1. This gives us a 55% chance this is the bottom, but it's got to break those blue lights. And oftentimes what happens is it'll break those blue lights and then it'll flush and come back down and test this bottom down in here. And that's kind of the next stage. Of course, if it breaks that bottom, then we're in the third drive, right? And then we could have to look for that third drive retracement here. And so that's what we would look for with that little ABC pattern. And the reason those ABC patterns happen is because that's how BlackRock, Vanguard, State Street, that's how they program their computers. That's how they do it. All right. So that's a pattern that is reproduced over and over and over again from fear and greed by you and me, the retail traders, but it's designed into the system. Remember, we talked about that yesterday. So I'm not going to go into it in great detail today because we talked about it so deep yesterday. If you want to understand this concept, go read, go watch yesterday's video. I went into it in greater detail. But that's what this is. This is ABC pattern, A, B, C, D, right? A, B, C, D. This is the ABC pattern that we're always talking about. It's based on fear and greed, and it's a psychological pattern that the quant systems have been designed around. Okay, so if you understand that concept, then you can understand why markets move through patterns the way they do, and that's what we're trying to do here. Is we're trying to reverse engineer, right? And that's why I put out on the little marquee that we're going to reverse engineer. We're going to reverse engineer the BlackRock system, all right, quant system. And so that's what this market does. It goes through ABC patterns like that. And that's what this is. This tool comes in here and it measures those ABC patterns. And so if you have track and trade, that little tool's built into the software. Now, if you don't have track and trade and you want to do this kind of a thing, it's a reflection strategy is what it is. All right. So what we do is we anticipate a market that makes 2 steps forward, 1 step back, 2 steps forward, 1 step back. And then we go through the delta cone of probability. All right. So you've all heard me talk about the delta cone of probability, and I got a little slide here for you to highlight that because it's one of the most important slides when it comes to understanding these markets. You have to understand the delta cone of probability. And I'm going to bring it up right here. There it is right there. And so that's the delta cone of probability. And so what we do is we have, hold on a second, I'm losing my voice. Give me 1 second. All right, here we go. The mean revisions suggest that asset prices have historically eventually returned to their mean or average price levels. Now, this is programmed into the system based on the fear and greed model. All right. Entry points. Traders look for deviations from the mean. 1 standard to 2 standard deviations are potential entry points for mean revision trades. Risk management understanding revision zones helps to setting stop losses and profit targets. Option traders use mean revision to write calls and or puts to center at the center of the 1 standard range deviation. The VWAP taking advantage of statistical averages. The price stays in this range approximately 68.2% of the time. Now, if we come back here, I got one more slide for you. Come on. There we go. So this is actually, I call it the delta cone of probability, but that's my name for it. I named it that because it comes from the delta. We designed this from the delta of an option. That's where this all comes from, right? If you're familiar with options, you have delta and you have convexity. And if you don't know what those are 2 terms that you can go research on your own, give you a little bit more information. So delta in options, in the options world, and convexity. You can go and and research those. Convexity is what makes is when delta increases in value or decreases in value. If the value of an option goes down, the delta decreases, therefore you lose money more slowly. And if the market rises, delta increases, which makes you make money more quickly. That's kind of cool, and that's called convexity. All right, but the delta cone of probability is the fact that the delta is always right around 50, right at the money. And so that's what you're seeing here on this little slide, calculating the delta cone of probability. The actual name for it is called the empirical data distribution rule. So if you want to go search that, it's called the 68, 95, 99.7 empirical data distribution rule. So you can go and do a little bit more research on that. And that's what we're talking about here. This is where we're approximately 68.2% of markets data stays within 1 standard deviation of the mean. So that's why we have all these tools like the chalk and money flow, the moving averages, the stochastics, moving average convergence, divergence, MACD. We have all kinds of tools. We have the Fibonacci ruler, we have Bollinger Bands, we have all these tools. What's another one that we've got in track and trade? It's called the let me see, the RAF tool. The RAF tool is also part of this standard deviation. So everything kind of works around and measures and models this delta cone of probability, or this empirical data distribution rule. And so that's why markets have a tendency to 2 steps forward, 1 step back. Well, 1 step back is moving back into the 1 standard deviation. It's approximately 68.2% of the market stays within that 1 standard deviation. Around 95.4 falls within 2 standard deviations, and nearly 99.7% of the time the market's within 3 standard deviations. So if you know that and you understand that concept, you can make predictions of where the market might retrace to or return to. All right, because it's a high probability that it's going to do it. Now, it doesn't have to do it, and it doesn't have to do it every time, because there's market dynamics that go into play. And I know that the big boys are always, running their quant systems that are designed on this fact. But the other fact is that they're also competitors. And so, come on, you dumb tool. Why do I have to do that? All right, so they're also competitors, and so they're competing against each other. And so they want to take each other's money as much as they want to take our money. But they're pretty smart guys, and they usually kind of understand what each other is doing, and they just kind of run the systems the same, which is why it ends up being like the 3 largest players in the whole world are always trading about the same, doing about the same thing. All right. And then they're all just fighting over taking our money. That's really what they're trying to do. So if you come in here and you look at the delta cone of probability, let's raise this up. I'm going to show you something. Fibonacci is the delta, measures the delta cone of probability, and that's what it does. So if you go from top to the bottom, that would be the 1 step or the 2 steps forward, and then the retracement back into what we call the Fibonacci sweet spot is coming back into that 1 standard deviation, right? And so coming back right to 50% would be exactly dead center of that 1 standard deviation. Now I call it the Fibonacci sweet spot because generally it's between 38.2 and 61.8. We're not building bridges here, and we're not building buildings. We're watching a dynamic financial market. So it's not always perfect. That's why I always draw that circle around like that and say between 61.8, 50, and 38.2 is the delta cone of probability. And so that's what we're looking for. We're looking for markets retrace, move through, make a move, and then retrace back into that 1 standard deviation. And that Fibonacci ruler helps us measure that. All right. Now, Fibonacci can also help us measure where it's going to go, what the next standard deviation is, or where the next move would be. And that's what this little tool here is. And so we use this one to measure that first standard deviation, that first ABC pattern. See, from A, B, C. And then we say, well, if that was the first one, boom, 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 that's probably where the second one's going to go. All right. So we can make a measurement, a swag, a scientific wild ass guess of where we think that's going to go. And then we can come down here and say, well, if it did that the first time, and 100% was the last time, that's how much it moved last time. This one went to the let's say 130.9, actually went a little bit further. So we're going to put it down like that. And then we're going to say, well, if it makes 1 standard deviation retracement, it's going to come back into the delta cone of probability, or into the delta sweet spot. All right. And so that's what this market's done. So it flushed down here. It went to the bottom. That was the one drive. We made a projection, and we could project at 100%, but we also have that 130.9, which is called the golden ratio. All right. So the golden ratio. 61.8 is also the golden ratio, but 61.8 is on the retracement. 130.9 is on the projection. Okay. So you have this little tool that measures and projects out into the future where that's going to go off of the first leg. And so then we project the second leg, and then we would anticipate, based on the low, the retracement back into the delta cone of probability, back into that 1 standard deviation. And that's why we have Fibonacci rulers. And so the Fibonacci ruler measures that delta cone of probability. Now, I'm going to show you something else that's really cool, because there's a lot of indicators that do that too. And so the indicators, let's say, for example, let's turn off this one here and just look at the stochastics indicator. So stochastics indicator, if we come into the settings of stochastics indicator and we draw a horizontal line in here, which we can do right at, let's put this one at, these are at 100. Let's see, this is at 80. Let's put it at 50. All right, we'll just put that one at 50, and we'll make that one, just for now, we'll make it magenta. I guess that's a good color. But see, that's your delta cone of probability, and that's what that stochastics tool is measuring. All right. So the exact one standard deviation from the high to the low. Now this is based on a 0 to 100 scale. So it's a little bit different scaling, but that's what they're measuring, all right, with this tool. You're measuring when the market has come back to the the stochastic sweet spot is what we're going to call it. We're not going to call it the Fibonacci ruler, but it's the stochastic sweet spot. All right. So this is what's called the exact same measurement is just based on a 0 to 100 scale with a mathematical model that's called stochastics. And it gives you the same reading. So that's what that tool is designed for. And so what we do with this tool is we come in here and we put that back up to 80. And so, and I'm gonna let's make that that's cool. Let's leave these magenta. I like a magenta. That's a pretty color. Okay, so we're gonna say like this. So what we're gonna do, and we could probably even come in here and we could say, you know, we don't have a fourth one. We could put one right dead center, but we could come in here and we could say, look, this thing is 80% and 20%. I wonder if we could figure out with these tools if we get a third one in there right in the center. Anyway, what we're saying is if the market gets way up above this region here, this is called the overbought region, right up in here. This is the oversold region. And so if that is the case, well, we actually are looking for the market to come back to the delta cone of probability, right? Or the one standard deviation. So we're going to expect it to come back to the center. All right. So as long as it's way up there, we're going to expect it to come down. If it's way down here, we're going to expect it to go up. It's the same idea, same concept with the stochastics indicator as what we're doing with the ruler, the Fibonacci ruler. So then we're going to come down. We're going to let's look at another indicator. This is the MACD. All right. So let's turn off this one for a minute. Let's remove that. Let's remove historic volatility. So we got the MACD in here, and the MACD is the exact same thing. All right, what it's measuring is it's measuring your now this one, the cool thing about MACD is it's not based on a 0 to 100 scale. It's a moving scale. So as high as the market wants to go, it can still go, and then it can as low as the market wants to go, the market can still go. So it's a dynamic tool that moves dynamically, but it still is measuring just like let's see if we can turn off this auto chart scroll. Okay, we'll scroll this up. So let's bring this bigger screen here too. All right, so the whole idea is what you're looking at now is you're looking at the same thing. You're looking at it's kind of a mathematical model that measures these moves in the market and tells you when the market's moving back into the delta cone of probability or the Fibonacci sweet spot. It's just being done down here. Now you have on this one, you have the same thing. You have a 50 zone. We could put that in here. We'll just put in 50. And we're going to make that a percent. So you have that histogram 50%, and it's going to do kind of the same thing. The difference is not based on a 0 to 100 scale like stochastics. It's based on a variable scale based on how big the market moves. And so you're going to get these moves and you're going to get these retracements. And so as it's above the one standard deviation, below the one standard deviation, that's where you're going to get these moves where the market goes through this one standard deviation. So that's how all these tools work, most of them. All right, not all of them, but most of them are measuring that one standard deviation or that delta cone of probability, anticipating where the market's going to go back to on these projections and retracements. All right, so it's kind of a cool tool, and that's how we measure, and that's how we reverse engineer BlackRock's system. All right, BlackRock, all the big systems. I just say BlackRock as a general term, but the whole idea is what we're doing is we're reverse engineering this model right here. All right, the fear and greed model. As it goes through this price and time, this is the fear and greed model that they base all of their trading on so that they can take advantage of us. Because again, what we do is we build upside down pyramids. All right. So we build upside down pyramids, they build upside right pyramids. So the idea of an upside down pyramid, let's clear all this data off and I'll show you. So what they're doing right now is they're building pyramid. And a pyramid means that they are building a position that is very strong at the base. All right. So like this. So they have a very wide base on their pyramid. Oops, wrong button. So they come down and they build a pyramid, which means they start off up here. And the big boys, they start to sell right up in here. And they sell as few as they have to. They don't want to sell a whole lot up in here. or actually they're buying, right? They're buying as we sell. So what they try to do, again, let me bring up my little model here, and I don't want to confuse people. So the idea is they want to take us through this process, this emotional process. So when the market gets way up high and they want to start making money on this, they're going to drive the market down. They take us through this process of optimism, enthusiasm, exuberance, euphoria. And that's where us, the retail traders, are buying, 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 buying. We're building an upside down pyramid, right? That's what we like to do. And then as the market comes down, we start to sell, 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 sell. Now, because everybody, remember, there's one buy for every sell. That means somebody has to be selling or somebody has to be buying for everything that you sell out. So if you're selling all the way down this trend, somebody else has to be buying. And that's called dollar cost averaging. So if somebody starts to sell, sells, or buy, 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 buy all the way down this trend, and then we get a little relief right in here, right? We start to buy, 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 buy. They'll maybe do a little sell, 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 and they'll make money up this thing. But what they're trying to do is they're trying to build a big position. And so then they flush the market one more time and they let it drop, and the drops, and everybody else starts to sell, 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 sell. Well, the big boys, banks and hedge funds, they start to buy, 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 buy. And so in that process, they're doing a dollar cost average all the way down, and they'll buy more and more and more and more as they come down, as the market comes down. They start buying smaller amounts because that's all that's being sold, but they'll buy everything anybody wants to sell. So everybody who's selling right in here, they're buying. They're buying, buying, buying. And as this comes down, this is panic selling in here, right? And so this is where they're buying a whole bunch. And what does that do to their dollar cost average? It draws it way down here at the bottom. So they have an average of price entry way down here. Now, if they want more shares, they're not going to let the market go up. Why? Because they don't have a big enough position yet. And this is a huge opportunity for them to just, man, they're going to make a lot of money because this is a big opportunity for them. So this is all they see this as, a huge opportunity to make a lot of money. So they're going to continue to go what they call the accumulation stage. And in the accumulation stage, they may drop this one more time and come down here so that they can get more people to panic sell. Now the question is, how many more people are going to panic sell? Maybe not very many, right? So they have to play another game. So if they try to drop it and try and get more panic sellers to come in, there might not be a whole lot more panic sellers left. So they can't get a lot more people to sell that they can buy their shares from to bring their position down. Now remember, they're huge, so they need a lot of people to sell, and there just might not be that many left. But so that'll determine. They'll try. They'll drop it, and they'll try to get as many more people to panic sell out of here as they can. And then they might decide, well, that's about all we're going to get. There's everybody else going to just hang on to their positions. They're not going to panic sell out. So then they'll take it through, because if they decide that, hey, okay, we got enough shares, they'll do a little panic sell, and then they'll run the market, and away they go, and they're happy and happy-go-lucky all the way up this trend, right? And they make lots of money. They could do that. But more likely what they're going to do is they're going to want to pick up more shares. And so they'll sit here and tease us. They'll drop it, they'll raise it. They'll drop it, they'll raise it. They'll drop it, they'll raise it. And they do that usually, I call it 3 times a charm. They'll usually run that like 3 times across there, sometimes more. But this becomes a very choppy state in here. It's very, very choppy. And what they're trying to do is they're trying to encourage traders to get into the market, only to have it flush again and then have them sell out, and then they take your shares. So then they get it to pop up a little bit more, and they try to get everybody in because everybody's waiting for this market to reverse and go up. So then they flush it again and take all your money, and then they'll do it again. And they just think it's so funny. They just sit there and laugh and laugh. And then they drop it again, take all your shares because you panic sell out because you're afraid it's going to go down, right? So they just sit there and play this game. It's called the accumulation stage, actually. And once they feel like they've got enough money, all right, enough shares, enough big positions, and they've built themselves this massive model down here at the bottom of this triangle formation, or this pyramid, they run the market, and then they let it go, and then they build it, and they drive that baby back up. And the whole way up the trend, what are they doing? They're selling, 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 while who's buying? We're buying. Retail traders buy, 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 buy. While the big guys, they're sell, 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 sell. They call it feeding the ducks. All right. They actually have a word for it, term for it. They call it feeding the ducks. We're the ducks. And so what we do is we build great, big, huge upside down pyramids. All right. So we come in, and what we do is we start like this. and we build these upside down pyramids. And so by buying all the way up there, they can come in and they sell out all the way up there. So they're selling all the way up that uptrend. So by the time it gets up here, they don't have any shares left. And who's got all the shares? Well, we do, retail traders. And we've dollar cost averaged up, so our big positions are up here. All the market has to do is move that far, and we lose all our money. We're out. And so that's why we start to panic sell up there. And then they start the whole game all over again. All right. So that's the model. Don't build upside down pyramids. That's the model that we want to kind of try and avoid. Unless you're smart enough to sell up here. You can buy, but then sell. Make sure you sell. Sell up there. We like to do a strategy called pillaring. All right. So if you pillar, what you do is you buy a bunch right here, right? You get it, you start loading up on your position, but you sell as you go up. Sell, buy, sell, buy, sell, buy, sell, buy, sell, buy, sell, buy, sell. Just taking profits along the way. So you're not building a great big huge upside down pyramid. Just take profits along the way, and you won't get caught with your pants down with a huge position up at the very top just to have it flush $2 and have you lose everything. All right. So that's the model, and that's how we reverse engineer what's going on with the big boys, and that's how they run their systems. And I would recommend that you study that delta cone of probability, because that's how you understand where markets are going to go and why. And then you also, it's just probabilities. It's not saying that it has to do it every time. And then get a little bit more comfortable with the concept of dollar cost averaging and understanding how that works, realizing that they're building upside right pyramids, we build upside down pyramids, and they do that to us on a psychological basis using quant style mathematics, and they take advantage of this fear and greed model right here, and that's how they build these systems. All right. And so if you want to reverse engineer them, that's how you reverse engineer, and that's how you win this system. All right. You don't build a pyramid, you pillar out of this thing, and that's how you do it. All right, let's go do some day trading. I promised in the little marquee that I would talk about that and teach you that little lesson. So now let's go have some fun. We're going to go see if we can find a market or two to trade. We might be a little late to the party because we've been educating, but that's all right. That's what we do in this class. This is a lab for our university. So let's come in here, and first thing I want to do is I want to pull this up. Look at that. Oh my goodness, it was all green there for a minute. You see, this morning I had it pulled up and it was all green. Now it's all red. So I don't know if we're going to find anything to day trade or not. There's probably nothing explosive, but we're going to go try. We'll give it a shot. Let's come in here to the bubble scanner, and we're going to come in here and we're going to change this over to volume, and we're going to see if anything's rising. NEM, that thing's took off and went like a shot. NVIDIA is rising. This has got to be, oh, that's Intel flushing out like a toilet. Where's Tesla? Tesla, it's down today about 3%. Apple's down about 0.5%. NVIDIA, AMD's rallying. Let's go look at AMD right now. This seems to be the only one that's Palantir's pulling back. You know, the thing is some of these markets will pull back in the morning and then they'll start to rally up a little bit later. So you get this pullback and then the rally. And so if there's going to be much of a rally at all today, we could use some of these markets that are pulling back the farthest, because they'll be the ones that'll rally back up. So Intel maybe. But let's just for fun go look at PLTR right now. Now, look at this. This is the S&P 500. It's trying to climb up here again. We needed to intercept those blue lights, and then it'll make a little flush back down. Like intercept those blue lights, and we'll see this thing flush back down, and the media will go nuts. Donald Trump is the Antichrist because the market's going back down. Just remember, it has got nothing to do with what Trump's doing. It has everything to do with the mathematical models driven by BlackRock and the other big boys. All right, it's all about accumulating shares for them, and they have trillions and trillions of dollars, and they if they don't want the market to go up, it ain't going up. If they want the market to go down, it's going down. If they don't want it to go down, it won't go down. The market won't do anything BlackRock doesn't want it to do. And so don't think that nobody has control over this. BlackRock, it's a carnival game. It is. Trust me, people. Trust me. Believe me when I say it's a carnival game. All right. The Fed might have a little bit to do with it. The Fed can move the market, all right, because they can change interest rates and they can do some stuff. But BlackRock's in charge of the Fed, so it's still BlackRock. BlackRock, BlackRock is God, all right, when it comes to the financial markets. They run everything. They're in charge. And yes, they have some competition at being God. And so there's a little bit of unknown in there on how that's all going to come together. But nonetheless, it's all a game. It's all a carnival game. It's all fixed. And all you have to do is reverse engineer what these guys are doing, and you can make money off of it. All right. So you just have to know the odds. All right. Here's Palantir. And Palantir, good company. People like it, right? I think BlackRock likes it. So let's do a little, okay, it made a little projection and then it came back down. Let's do one more. We'll go back this direction. So I go from here down to here, up to here. Came back down to 50%, 61.8, just like a train on rails. And if I say that train on rails, that just means that this baby is following the BlackRock model perfectly. So you can tell that when it hits these Fibonacci numbers, just like dead center, right to it, you can tell that these markets are being manipulated, controlled, and traded by the quant systems over in Wall Street. Let's just call it Wall Street. All right, because they're the big boys on Wall Street. So they're running it with computer systems. And computer systems, although, they're not the only computer systems running, they're the biggest, baddest boys on the block. So they can kind of drive it to where they want. And when it hits certain numbers, that's when they make their decisions. So I think this market's going to give us a little bit of a accumulation stage in here. I think we're going to probably see it bounce maybe a couple of times, maybe even a third time. I don't know. We might get 3 times a charm. But the pattern here is just a little head and shoulders formation. You can see coming in here like this. And is it going to go down and break and do a third little pattern and break this low and come down in here? It certainly could. The projection is down to 90 to 100% down in this region. We got 130.9 clear down there. I don't think we'll ever see Palantir down that low. But it's trying to climb up here. It's not got a whole lot to go because that little natural trend line and those blue lights are right in there. And those blue lights have been tuned in. We've done a really good job of creating those blue lights. Those blue lights have tuned in to the BlackRock formula, and that's what those blue lights do. They kind of help us understand the wave patterns that the BlackRock system does. So they're kind of a way of reverse engineering, and that's what those are doing for us. So that's how we get our probabilities. And so we've tuned those in the very best we can. Now there's you can move that tuning fork around, right? Make it a little bit more aggressive, a little bit less. And you can see how that tunes that market in. But 72 is the one that we've discovered is the one on the progressive formula. Progressive formula 72 is the one that's kind of, and we don't need all the arrows on all color changes, but this is kind of the formula that we have discovered follows that BlackRock formula like a train on rails. All right. So kind of use those settings. Hit save as my defaults. And that's the one you want to use on that bulls and bears system. All right. So these recurring price patterns are the ones that come in here. And this is how you measure where those are going to go. So this is kind of the pattern at the bottom. And remember, if it goes down and makes a third one, we just move this whole thing over and this becomes left shoulder. We line that back up and we have head down here. So we're just going to measure this and see where they're going to take it. We don't know, right? We don't know. So we just have to try to reverse engineer what they're thinking and what they're doing. Shit off. Okay, so here we go. So that's what we're looking at. And Palantir is making a little run today. So let's come into the 1 minute chart and see. Not much. Oh, that was just this morning. Look what it's done now. It's flushing out. Let's turn on our Heikin-Ashi bars so we can see a little more clearly what's happening. Those are the cheat codes. Well, Palantir tried to climb a little bit. What was it this morning? Oh, that's what made it hit the target. So that's your 5 o'clock this morning. Boom. And then it went over. And usually that's a really good signal for us. If that fails, that's a rough time. So 7:30, well, it tried to rally, but now it's coming back down. And we're not doing too well. So that's Palantir. Nothing to really write home to mama about on this one. So if we come back, see, we're kind of losing our little mojo in there. It rallied up at first. Now it's kind of dropping back. It didn't break yesterday's previous high. So keep that in mind. See that in there? Make that a little bigger for you. Kind of breaking that. It touched, oh, well, it did. Look at that on Palantir. That bar right there touched those blue lights. So we got blue lights down here. Oh my goodness. See that? See how accurate that thing is? It's unbelievable. Okay, so it broke them, and I don't think it's going to continue up. I think we're going to see this thing come back down, create a right shoulder. Is it going to break low below that head? That's the question. We don't know, right? We're just going to have to wait and see if BlackRock flushes that thing enough to make it break and come down here. And if it does, if it breaks that, well, our target zone of support, I always put 90% in there because markets don't always do 100% of everything you want them to do. So I put that 90 in there. You'd be surprised how many times it comes right down to 90, turns around and goes back up. People get a little excited, 100%. But 130.9 is the golden ratio. I don't think we'll see it down there. I really don't. Unless BlackRock is really pissed off at Donald Trump. We won't see that market down there. But they're really pissed off at Donald Trump because they're globalists, remember. And Trump is shutting down the globalist world economy there, kind of. He says he doesn't want to do that. He says he just wants to have them be nice to the U.S. But in the process of being nice to the U.S., he's got to take some of their money away. So we've been to the tune of $35 trillion, giving all that money out through globalism, giving all that money to the rest of the world. And now we're like, well, now we're so far in debt, we're going to go bankrupt if we don't take some of that money back. It's like it's doing people a favor because that's what all of these trade negotiations were done. You hear Donald Trump say all the time, he's like, who is the idiot sitting behind this resolute desk making these decisions? Nobody would make this deal. Well, the reason they did it was because they wanted to give those countries money, right? They were trying to be nice to the whole world and give everybody lots of money through trade. And that's how they were doing it. And that's why they did it. Because they're globalists and they want the whole world to be happy. And you have to have, it's one of those situations where you can't have one be really high and all the rest low. If you want to bring this one up, this one has to come down. And that's that, it's the theory of economics, if this one's really doing well and you want to bring these up, you have to bring this one down to bring these up. So everybody's on a matching playing field, right? Of course, the U.S., that put us $37 trillion in debt because even though we were like, okay, we'll help you guys through trade and we'll bring you up. Well, instead of bringing our livelihoods down, we just put it all on the credit card because we didn't want to start tightening our belt. No, we don't want to tighten our belt. We just want to make you guys better. So how did we do it? Rather than bringing our livelihoods down to bring these guys up, which no president wants to do either, right? So they just started putting it all on the credit card and letting all that trade go out the door and then still letting the American economy grow. Because you can't have both. You can't have the American economy grow and then give all of your American economy to the rest of the world. That's going to make the American economy go down. Well, they didn't want the American economy to go down. So rather than making the American economy go down, they put it on the credit card and just gave all that money out the door through trade. And that's how we became so far in debt. Eventually somebody's going to have to pay that debt off or else the U.S. is going to go bankrupt. If the U.S. goes bankrupt, the whole world goes bankrupt. I mean, it just destroys everybody, right? The whole model falls apart. So we are the big consumer. We buy everything from everybody. So suddenly there's no buyers. It doesn't matter how good your product is to sell if there ain't no buyers. So we got to do something. We got to fix it. And we keep saying, well, we're going to kick the can down the road, right? And let the future generations fix it. Well, the future generations are in there trying to fix it right now. That's those kids in Doge, right? We let them come in and fix the problem. And then we scream and yell, oh, we don't want them to fix the problem after all. It's our future, you dumbasses. Get out of the way. You're the ones who destroyed it. Now let us come in here and fix it. Can't blame them. They want to fix it, right? So let them fix it. Yeah, it might be a little painful, but you do people a favor. It's one of those psychological things. If you do people a favor one time, they thank you. Oh, thank you very much for the favor that you just did for us. That's really awesome. Thank you for that great favor. You do the favor the second time, they're like, oh, Yeah, it did me a favor a second time. Now it's not quite as cool, right? The first time. You do the favor the third time, and there's been psychological studies been made that if you do somebody a favor 3 times, it's no longer a favor, it's now expected. And so if you take that away, they have resentment towards you. If you do somebody a favor one time, oh, they think you're wonderful. There's never any resentment from that. You did a favor. The second time is kind of that flip. It's like, oh, this that he did me that favor again. He must feel like he owes it to me. And the third time, well, when you do somebody a favor 3 times, that's all it takes. And their brain clicks, boom, that's no longer a favor. I'm expected. You'd owe that to me. I deserve that favor. And so if you stop doing it after 3 times, that's all it takes. 3 times to do somebody a favor, they now will have resentment if you stop doing the favor towards them. They will resent you. All right, this market's still flushing down. This is a little. We could short it. Let's see if it'll let us short it. Let's put 100 shares short. We'll try it. We're not going to let it go far. We'll just put just 1 bar right there. If it doesn't just keep going down, we'll get it out. So we'll take a little short position right here on that little shelf. It might not keep going down. You see our slow stochastic is way down in the lower region. So this is telling us that it's got to pull back into the delta cone of probability, right? So there's a possibility it could just come right back up. But that's also a little shelf, a little pattern, little ABC pattern. ABC, it could drop again. We'll see. We don't know. We're just going to put it in there. We're not going to take a big risk. If it doesn't keep going, we'll just get out. So anyway, that's the whole name of the game. You do people a favor, and that's what we've been doing, right? We've been doing favors for the whole world and helping them grow their economy a little bit on our credit card. And then when we stop and we say, well, we're not going to let you do that anymore, everybody freaks out. Oh my God, you're not doing my favor anymore. I'm going to die. Like Canada. You know, you do a little favor for Canada and say, okay, we'll help you, Canada, to the tune of billions of dollars. Oh no, you're going to do it. You're going to stop taking away our favor. Well, then we're going to retaliate against you. We're going to get all pissed off. Okay, sorry we ever did the favor in the first place, right? I mean, sorry we ever did the favor in the first place. So that's the problem. That's what's going on right now. We're taking back all of our favors, and it's pissing everybody off. So Trump's like, all right, well, we'll negotiate something new then, a new favor. So it's a little bit more fair. Okay. You know, China's like, no way. We ain't negotiating no favors. But we've been doing favors for China forever. We're trying to help them, help that country, right? So anyway, stop doing your favor, and then it's no longer a favor after only 3 times. And that's what's going on. So keep that in mind with any of your relationships, personal relationships, business relationships. You do somebody a favor on that second time, you do it the third, it's toast. That's all it is. It's no longer a favor. Come on, little market. We're up $16. It's not bad for a couple hours. $16 an hour. There's $35, $38 an hour. It's not even an hour. It's just 100 shares. How much was 100 shares? Well, it's trading at $85, an $8,500 investment. Now you know why we like to trade futures, right? Why we like to go over to the futures market and trade with a $8,000 in the futures market. That's coming back on us. It's coming back. It says, nope, we ain't going any deeper. So I hit that low one more time and it said that's the bottom. So let's see if we lose 20 bucks. Didn't follow through, did it? Said that's it. We're done. We're hitting that second bottom right there, and up we go. Now we're going to rock and roll to the upside. So that was that failure right there. It came down, made that little shelf, didn't keep going. So let's see if it comes up, what it does with those blue lights. Remember, those blue lights are the quant system. We'll see if it'll break through them or if it just touches them and turns around and flushes back down again, because that happens a lot. Comes up and then breaks those and touches and goes. In fact, if it go up there and touch it one more time, we could take another short position off of there. Doesn't mean it's going to go down. It could just keep right on going, but oftentimes that's what it does. It'll come up, touch those blue lights, and then flush back down. So we'll see. Shows $1,800 down. Let's just watch this one chart. Closed positions. $37. So we got to make $37 to get our $37 back. We got another little target zone right here. That's the next one right there. We could say 100 limit. We could do 2 of these. We could say if it comes up there, we'll take another one out. Oh, they're not going to let us do that. Why won't they let us do that? Is it too much money? Let's result in a net short position and only allowed as day orders. Oh, let's come in here and change that to day order. Unfilled day orders will be deleted at the end. Okay. Limit. So we put that right there. We'll see. See what it does. Maybe this is the bottom return and we'll turn around and go back up now and we'll get our hiney handed to us. This is 2 drives down. So let's label this. This is X1S A1. 25% chance that that's the bottom. And it failed to be the bottom. But this one here, this is an X2S. X2S A1. It's a 55% chance that's the bottom. Better than half. That could be the bottom right there. Turn around and go back up. And we're short, so we'll see. We're losing another $34. And this is where we'll dollar cost average in. We got 100 here, and we'll put on another 100 if it'll go up and touch that area of resistance. And then see if we get another little ABC pattern out of it. Another little shelf in there. Don't know. Do you think the market's going to rally? You think we're going to get a 9 o'clock rally? Who knows? We got an X2S A1, 55% chance that that's going to go up. Keep on trucking. Not very active, is it? It's a little on the slow side. Though people are buying. Don't like to be short when you got a 55% chance. You could be wrong. Len, why didn't you just look at the indicator? It went from red to green right there. This was all accumulation stage. Distribution. What are you doing? Well, we'll see. We'll see. We were just looking to see if it's going to make one more fluff out. Might be wrong. I've never been wrong before. Touch it. It's like candy. Take that candy right there. Take the candy. Ooh, we're a little bit up farther than the candy. Take the candy. I should have had that down just a little bit further. I was up a little bit too high. There we go. All right. Okay, let's see if it'll back off right now. Flush, baby, flush. Let's see if I can make this bigger for you guys. You can see it a little better. Bring this down a little bit more. Let's see. Bing, 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 bing. Dun, 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 dun. How's that? Can you see that better? Let's see if it won't flush now. We're in the neutral zone. Bars have gone yellow. You take your Fibonacci ruler and you can measure from the bottom like this. Bring the Fibonacci sweet spot right up over the top of those yellow bars, just like that. That's our upside target up to here. So we'll see if it'll flush back down a little bit. But we may end up with this thing up here. Okay, we're up $3, so we got our money back. We could get out and just say, okay, we don't think the market's going to fall. We think it's going to continue higher. But we'll wait and see. There it goes. It's going to go up. It's going to break that high. There it goes. We should probably get out and take our loss at this point because that next Fibonacci zone is way up here. Maybe that red line right up in there, right there. We'll wait one more time, see if it's not going to just test that and then come back down. Because we have those blue lights coming in there. That's like the natural trend line. We got the natural trend line coming up here. We got the mathematical trend line, which is going to be those blue lights. And then you got the horizontal, which comes off the bottom. And that's our speed fan. Got a lot of lines on the screen, but most of them I'm just trying to show you where things are going to go, where I think things are going to go. All right, here it comes. We're back in the green. We could just take it off right there and say, I don't trust it to fall. But I still think we got some downside potential on this thing. We might get one more drive down or at least a test down, but that Fibonacci, it's a pretty solid projection. When you get a market like that and it goes through a yellow zone like that, we oftentimes see it go up to that point there. Put that, lace that right over the top of those yellow bars, and it'll go all the way up to there. Because that's the cone of probability. That's the delta cone right there, right? Let's get rid of some of these trend lines so we're not so busy. Get rid of some of these arrows so we're not so busy. It's going through the delta cone of right dead center of the delta cone right now. Sitting there at that one standard deviation on the projection side. That's what that is. So we'll bring the speed fan in. This is your natural trend line. And it already kind of broke that natural trend line like that. Getting very neutral in there. This is the mathematical trend line right here. And then, of course, you get the horizontal down here. That's called my spider web. You can learn about the spider web in my book. Your book? Yeah, I got a book. I put all this stuff in the book. Lan H. Turner on Amazon. Just go search it. Lan H. Turner on Amazon. You can have the book. 238-page workbook. It's the manual to the class. Oh, look at it go. Yeah, we're probably going to get our 90s handed to us on this one. I think that might go all the way up to that blue line, at least to the red one right here. Right up in here somewhere. Ooh, what happened? Why did it do that? I didn't do that. Yeah, turn that off. How many times do I have to turn that off? To keep turning it back on. I don't know what the heck is going on with that software feature. That auto scale, they just keep turning it back on me all the time. I hate it. If I turn it off, I want it off. Get out, Lan. Why are you hanging on to this position? Oh, I don't know. Just to learn. See what it does. It gave us several opportunities to get out at break even, didn't it? What's that line right there? That's a 100 period moving average. So that's the 100 period moving average right there. Let's see if it breaks through that Fibonacci, goes up and honors that Fibonacci number. Yeah, we thought we might get one more dump out here, didn't we? And we didn't. It turned right around on us. We got that little double bottom down in there. We should have known better. But I thought it would hit those blue lights and then give us a little bit of a flush back down and test that low again. I thought we'd get a nice little right shoulder off of that head and shoulder, and we didn't get it. I thought we'd get that little push right there. And that didn't come in for us. Just keeps going up, 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 and away. There it goes, right to our Fibonacci projection, just like we said. If it goes through that, breaks out, goes up, it's going to come up right up in here. Got a little bit more. That's the first one, that red line. I think it's going to go to this one here. This would be the Fibonacci number right there. Did you see how I did that? But when you get this little zone in here, this little yellow zone, you lay your Fibonacci ruler across there, make that the Fibonacci sweet spot like this. And then your projection is to the next level, which is right there. Let's see if it goes up there. We got this line right here. This is the other delta cone center right there. From bottom to top where the market previous was. That's our delta cone of probability right there. One, two, three, four green bars. Well, that didn't help us much, did it? Just playing with fire right now. Playing with fire. How many times we got burned trying to dollar cost average up like that? It's a good lesson. Seems like every time I do it, I get burned. Not every time. Sometimes I made a lot of money doing this stupid dollar cost averaging up, but more often than not, I get burned. It's not worth doing. Just stop out. Just take your $20 loss and $30 loss and walk away. Because look, now we're down $200. It'll come back. It'll come back. I hate playing that it'll come back game. If you're wrong, just get out. If you're wrong, just get out. I think that's a good lesson to learn today. If you didn't learn anything else, don't do what Land did today. If you're wrong, just get out. Don't keep trying to build your position. Come on, baby. I'd pull out the voodoo dolls and start poking him, but we can't blame the voodoo doll today. This was just our dumb strategy. Can't blame the voodoo doll today. Not his fault that we did this stupid move. It's trying to break that line, isn't it? It's tried 1, 2, 3, 4. This is the fourth time it's tried to break past that 50% zone. That delta cone, 50% delta cone, it can't do it. Are we going to get a reprieve here? The blue lights are still clear down here below our entry point, our average price. Here it comes. This is going to let us out. Is it going to let us out? It let us out. So we didn't lose anything anyway. We also are not going to make anything on the rebound either, but that's okay. Close position. We got all of our money back that we lost. So we made $3, lost 37. So we're back to being $34 down, I guess. We should have gone a little bit more, huh? And got the $37 back too. Oh, well, we'll see. Okay, it's coming in on that natural or the mathematical blue line right there crossed. Land, you build your big position up. Now you should have hang on to it and let it come all the way down. I didn't trust it. I didn't trust it. It'll probably come back down to the Fibonacci sweet spot, right? Let's bring this down to the peaks. So that delta cone of probability is right here. It'll probably just come right back down in there, and then we're going to expect it to go back up again. Right? Stochastics is way up here in the upper region. See that? Coming down. We started getting in to the short side down here. What a mistake. What a mistake. Well, I would have been a hero if it would have kept going down on that break. But no, can't be a hero today. At least I'm not a zero, down $500. Not a hero, but I'm not a zero. Let's go see what else is cooking over here. Anything else cooking? AMD, Apple, NVIDIA. Let's go look at NEM. It's probably going to be pulling back by now. NEM, we might have missed that opportunity. Ooh, look at that baby. Newmont. Is that Newmont Steel? Is that why that thing shut up? Because of the steel deal? The steel deal. Look at that baby. Oh, 5 o'clock. Oh, there was our key. You look at the 5 o'clock bell. If that thing rallies, then when the 7:30 bell comes, expect a rally. That's how that works. Doesn't mean it always works, but a lot of the times you can catch that big run off that 5 o'clock notification. It's kind of over now, isn't it? We got a nice little head and shoulders formation in here, just like that. Kind of came in just like that, didn't it? It's kind of an ugly little right shoulder up in there. That was your natural trend line coming in there, and boom, right into the red line, right into the red dots, into the red bars. Now we're going through, what is that? Label it, Lan. Label it for me. All right. X1S A1. A1. X1S A1. That's your probabilities. Now we got a nice little tiffity-doo-doo right there. A little mathematical one, and then a little horizontal one right here. Yeah, there's that red line again. Right there. That red line is a halfway mark between the high and the low way back there. I don't know. It's kind of right there. But this would be a little bit more accurate to the 7:30. Oh, what happened? Wrong tool. So grab that right there like that. That'd probably be a little bit more accurate. So there's our delta cone of probability right there. Fibonacci sweet spot. So now you're dead center. What are you going to do? See, your stochastics is dead center too. Look at that. Stochastics right there, dead center. See that? Chalk and money flow crossing over the median line of the. They're all telling you the same thing. We're dead center. We're neutral. Completely neutral. Even MACD down there. It's all neutral. All neutral. That's what all these tools tell you. All these tools tell you about the delta cone of probability. That's all it is. 1 standard deviation, 2 standard deviations, 3 standard deviations away from the mean. Oh, you want to hear the RAF? Here's the RAF. I heard you say RAF. What's the RAF, Lan? It's that RAF channel right there. That's a really cool little tool. I like it. It's the 1 standard deviation. If you come in here to your preferences, you can see on the RAF that you've got is just a 1 standard deviation tool. Calculation is normal. You can go 2 standard deviations, and it's not much different on this one. Just go normal. There you go. So we're just kind of dead center of that thing right now. Look at that. All those tools are telling you the same thing. All those tools tell you the exact same thing. You're dead center of the neutral zone. Every single one of them. What's going to happen? What's going to happen with Newmont Corporation? Are they going to get us a little rally in here or what? You want to take some long? It's not really a trigger. It's bouncing off that red line. It could turn and go back up from there. Would be small risk. We wouldn't have to hang on to it like I did last time. If it failed, we just get right back out. I don't know if it's going to bounce off of that or not. Let's just assume it's going to. Put a stop in there, right? We're not going to be stupid this time. We're just going to stop out if we're wrong. If it breaks below that 50% zone, we'll just get out. But if it bounces off of it and goes back up, we'll stay. We'll see if we can make a little money off that bounce. But the trend is down. Don't forget, we're looking for a reversal. Those are a little bit harder to catch. Especially where you get a little flip-flop. This is up, down, so it's probably a pretty good chance this thing could come down and stop us out. Yeah, come on. Bounce for us just a little bit. Give us $35. Come on, baby. There it goes. There she goes. We only need $35 to get back to break even. Don't want to go home penniless. Penniless. This is our last trade. Win or lose. We'll call this done. We'll call it done for the day. While we wait. Did you guys go pick up your Pit News magazine? Pitnews.com. Go get it. Pit News magazine. Pitnews.com. I need to get a little jingle. Pit News is your magazine. If you're smart, you'll have it. If you're dumb, you won't. Does that make people want to buy it? Pit News magazine. Dumb people don't have a subscription. Smart people are the only ones who have Pit News magazine. Make yourself smart. Get yourself subscription to Pit News magazine. That's where you get all the spreadsheets too. All the spreadsheets come with Pit News magazine. It's only $39 for a whole year. Boy, it's lively today, isn't it? There you go, $115. Oh, that's what we wanted to see. Oh my goodness, oh my goodness. All right, we're rocking and rolling. Gonna touch those blue lights. That's what we wanted to see. We'll bring our stop up. Because oftentimes those big bars like that just turn around and flush right back down. Doop. And we're out. $171 profit today. Realized. That was a lucky break right here at the end, wasn't it? All right, guys, that's all I got for you. If you guys had fun and you enjoyed it, then go ahead and hit that little thumbs up. I always like to see the little thumbs up. That means we're on the right track. We're having fun, enjoying our time here, trading, learning a little bit about how to trade. And software we're using, of course, is Track and Trade. If you want to use the software we use over here, it's Track and Trade. Trackandtrade.com. Go to trackandtrade.com. We need lots of jingles. Trackandtrade.com. I'm using the stocks version today. And that's the name of the game, guys. And if you want to play, come and play with me. All right. We'll see you guys tomorrow. Actually, tomorrow's Saturday, so we won't see you till Monday. See you Monday, and we will review these markets one more time and see what's going to happen. Come and join me Monday morning, 8 o'clock a.m., bright and early.